Hey guys, how's it going? In today's video is going to be my top 3 stocks to buy of January 2018. I do not want to make a this is not a recommendation to buy because I still okay, this is not really a to buy, but it's the video of the title is to buy. This is to watch, okay? To watch. These are the stocks to watch because I do not recommend buying anything at the moment. Everything looks really bad, and I'll be making another video on that later. Why I think everything looks bad, and you should be careful. So before I begin, I just want to talk about Kiwi Mango Haze. This product is from Wayland. I showed you off this already, but I'm going back to this. I smoked it. I thought, it smells good, but, it gave me, really dry mouth. It felt like my mouth was full of paste as soon as I smoked it. Maybe they put some kind of chemical in it. I have no idea, but I'm going to give my friend, maybe it could be also a mix it's a mixed CBD / weed type, but if I've already had something like that and I never had, dry mouth, this gave me, extremely dry mouth. I'm gonna get my friend to test it, and I'm gonna get his opinion on it, see what he thinks about it. But right now, I'm not really a fan of Wayland. I would not support this company. I'd probably try out more of their products just to see. But regardless, I'm not really a big supporter of Wayland right now. So my top 3 stocks in December 2018 Christmas rally. I was wrong on 2 of the stocks and was right on 1 of the stocks. One of the stocks I was extremely wrong on, but we didn't have a Christmas rally, and we're having a Scrooge rally right now. So yeah. Hey guys, so I'm just gonna fast forward it to the point where I mentioned the stock. No, it's not Tesla. So my first recommendation was Ianthus. Ianthus is right now $5.78, and the video was 641. I did say that we might not have a Christmas rally, but the stock went all the way down to $4.75, and then it rallied back, and then I'm thinking that this stock is heading back or even possibly lower than $4.75. I could be totally wrong, but I was wrong. And if you guys bought at when I said it, if you bought, I didn't say to buy. I said to watch or to do your own research. But it bounced back. But I believe that it's heading back to this. It's heading back to this base because the market is terrible right now. And then my second recommendation was NBEV. I recommended NBEV at $4.29. I said that this is one of the companies that I really liked, and NBEV went up. NBEV gave you a Christmas rally if you bought it. This is the one company that I really liked, and it went up massively. So I'm still a shareholder of NBEV, and I plan to be a long-term shareholder. I sold off quite a bit, but I still have about 5,000 shares left. I probably not going to sell any more shares because, I'm comfortable losing all that money. If it was 5,000 shares, I've already cashed a big chunk of profit. And unless this stock goes to $10, I'm not cashing out anymore. And if it goes back to $4, maybe $3, I'll definitely add big time to my position. Way bigger than last time if it goes back to $3. But I don't know if it will. And then my third stock recommendation, this one was horrible. I recommended liquor stores. I said that in this video, I said that I did not recommend buying at $8.15. I recommended to wait, watch it, and buy it around 6 below. And right now the stock is $4.79, and they just cut their dividend. So this stock is no longer even a value stock. It's more of a trader stock. Unless this company can prove itself that it's gonna grow massively in the future, this stock is probably gonna be trading between $2 to $4. I think so, as I don't believe that this stock's heading back to $6. I believe that this stock is heading even lower. I think we're heading to a new all-time low for liquor stores. I think this stock's going down to like $3, possibly $2. At $3 or $2, I may, pick back my position, because I don't think the company will go bankrupt. But I would not touch it right now. I don't care if the stock goes to $6. I won't touch the stock unless I see a $2 to $3 price tag on it. But I was extremely wrong on this stock. I don't get it. Sometimes this one looks like a non-speculative stock, and yet the stock price just plummeted like no tomorrow. Now it's probably going to be treated more of a trade stock versus like a value stock, because they used to pay dividends. Now they just cut their dividend. It makes sense why they cut their dividend, because the stock price is so low that they'll pay a lot of dividends, I'm guessing. I don't know. Okay, and that's it for my 3 recommendations. Out of the 2, I got 2 wrong and one extremely right. And then okay, hold on. I can't NBEV here. So my one recommendation is CanTrust. This company was profitable. It's a Canadian company, and they have a decent amount of inventory. They have the same amount of inventory as Afria. I still think this price is going down even further. So keep it on your radar, just because this company has the same amount of inventory as Afria, and it has nowhere near the market cap of Afria. So this has a potential to double your money, and they could be a takeout target in the future. They could be, but Altera looked into them and didn't really want them. They looked in Afria, didn't really want Afria too, and they went with Kron because I guess Kron has a good science team. I really don't know. My next recommendation is Apple, because Apple has declined so much. I say that a okay buy would be $160, but if this stock went back to $100, that would be a screaming buy. That would be a very, very good buy, because you could potentially double your money again if the stock goes back to $200, or you could just you still get a pretty decent dividend on Apple. So if the stock goes back to $100, it'll be a great buy. But $160 is not bad. But $100 is when I would back the truck up. I would put probably $100,000 into Apple if it went back to below $100, because I think at that point it's very fair value for Apple, and I'm willing to make a big gamble on Apple at $100. But we'll see if Apple goes to $100. So this is more like a watch stock. Don't buy it. True Eve. True Eve would be my 3rd recommendation. This is a U.S. company. They're only in one location right now. They're in Florida, and they're doing very well. The only problem with this company I have is the total asset. They have a total asset of $140 million, and they have a $1.15 billion market cap. That's really overinflated. They have liabilities of $23 million, giving them a shareholder equity of 90. Oh no, they have a total liability of $48 million, giving them a shareholder equity of $91 million. That's not good when you compare it to the market cap. So, this stock is at its all-time low, but I put it on your radar because They are very profitable. Their revenue was $28 million. Is one of the highest revenues that came out of the U.S. companies so far. And they were profitable too. They were $17 million in profit that quarter for a total of 18 cents to the stock. And they have a total of 100 million shares, I think. A little bit more than 100 million shares. $1.15 billion. I say if this stock dropped to, I don't know, like $7-8, then it would be a good buy. But we'll see what happens though, because you know it's the age of opportunities right now. There's lots of opportunities out there. Like you know, these are only recommendation, not advice to buy. You know, just out of my own research. Especially Apple, if you want like a really safe stock, because Apple paid dividend, they make billions and billions of dollars. So like, can you really go wrong with Apple long term? 5 years down the road, I don't think so. I think Apple will, once 5G comes out, Apple will be a dominant cell phone player again. So right now, cell phones are slowing down, but when 5G comes out, I think the cell phone market will pick up again and Apple will be dominant. But I also heard that Apple is waiting on the 5G. They're waiting for all their competitors to come out with 5G first, and then when everyone has 5G, then they'll come out later. But that could be a bad strategy. But we'll see what happens. That's their strategy. Tim Cook is not a very good CEO. When Steve Jobs was around, Steve would never use debt to finance anything. He wouldn't do buyback shares. He would just use the money to keep innovating, creating, and making new products. Steve Jobs, what's this? Tim Cook, he doesn't really do that. He just goes, we buy back shares, we pay dividends, keep buying our stock. I don't know, that's not a very smart strategy. It's all about growing and innovating, and Tim Cook really doesn't do that. So that's why I feel like if Steve Jobs was around, I would never be bullish on Apple. Apple lost its like innovation touch. Just my opinion though. We'll see where. I mean, if Apple goes to $100, I'm still gonna buy Apple. I might make a small position on Apple at 160 because I think I can make a nice bounce play. Because I think that it will hit 160 and it'll go up to 170 and then maybe it'll go back down. I don't know. Or I could just keep falling and go way below 160. We'll see what happens though. But I think I'm gonna make a small position at 160. You know, like maybe a $10,000 gamble bet, and hope that, you know, it doesn't plummet anymore. So anyways, thanks for watching, guys. I hope you liked this video. Subscribe for future updates and have a great day. Bye.